markets, where it's the financials once again which are down. So as I look at my screens, Enables Housing Finance down another 6% after yesterday's respite. Canfin Homes again a 6% fall for the futures there too. Repco Home Finance, Shrey Infra, these are all stocks which are down. LIC Housing Finance as well added to that basket, which is down about 1%. So NBFCs it is, considering that they've been under pressure. Is there going to be a margin impact because of higher funding cost? Will growth then moderate? Those are the questions that we're going to pose today to Ramesh Iyer, MD at Mahindra and Mahindra Financial Services. Ramesh, morning. Good to have you on the show. Do you really see a moderation in growth for you just on account of rising rates and the trust deficit that we're seeing towards NBFCs at large?
I think it's a little overreaction. Yes, of course, the borrowing cost is going up, but we shouldn't forget that we will move into the festival season. And as we look at rural, I think the sentiments for retail is still holding up. And I don't see a pressure on volumes. But yes, will we be able to pass on the entire borrowing cost to the consumer? My view has always been, in a situation like this, the OEM, the dealer, the financier and the consumer, all four takes the share of the increased cost, and it is not any one who is going to take the full burden.
Okay, so are you seeing banks then moderate lending to NBFCs, or would you say that that's more panic as opposed to reality?
At least as of now, we've not heard someone telling us we won't be able to provide you the money. And therefore, I think it's important to wait and see what is RBI's response is going to be. And all of us would actually keenly look for in that response, what's the direction for liquidity.
What is the AUM growth that you're seeing for the business for FY19? And also, since you focus more on the rural front, how much demand for credit is coming through in rural India?
So for us, in fact, almost all our lending is into rural India, and when we say rural, a little of semi-urban, but definitely not in urban India. We are not present here. In as far as growth is concerned, we have had a 15, which we kind of rewrote to say we would be able to grow at 18-20%, and we are not relooking at that growth rate at all. One, of course, the demand is still continuing to be high. We don't see too much of competition around there, and our own collections have improved, which will support our growth. I think put all this together, at this stage, we are not relooking at our growth rate to be returned downward.
As a vehicle finance, NBFC, do you think that you have some borrowings from the CP market, the commercial paper market, at about 11 to 12%? With the recent rise in short-term borrowings, what do you make of the surge in the short-term paper rates?
I missed you in between, but the way I understood your question, it's important to look at what's the ALM match for NBFC, and we have an extremely good ALM match. We don't have too much of short-term borrowing, and we have not resorted to that ever in the past as well. In as far as the borrowing cost is concerned, as I said, whatever little increase that will happen, whether we pass it on immediately or not, but over a period of time, some portion of it will get passed on. Surely the cost of money is going up, and therefore the lending rates will go up. I don't see an impact of that on demand, because there is the need for the vehicle, which is very clearly visible.
Okay. Have you borrowed from the CP market in the last few days, and if you could quantify that?
We have borrowed, but a very small amount, I think about 200-300 crores kind of amount. And as I said, we have a good match. Any money that we are currently borrowing, if we borrow, would be to kind of replace the maturing liability or to interchange any product. And we have a excellent product mix from every source, and we have a deposit accepting license. We do see our deposit collections substantially improving even in the last few days. And I think therefore one has to look at what are the different sources of money. Yes, the attention is going to be towards what are the direction towards availability of funds. I am not denying that fact, and that's going to be the attention from now on, and we all expect that definite directions will come from RBI on this.
Okay. As interest rates are on the rise, Ramesh, how is it that you're going to manage your borrowing mix change going forward? And will you raise more public deposits in that case?
No, so we do already have, as I said, about 10-12% of our borrowings was deposit. That will go up as we see deposit definitely increasing day by day. So we will go up to maybe even 15 odd percent. But deposits definitely are not the cheapest source of money. They do come with a little increased cost. We do expect our overall cost of funds will go up by at least 50 basis point even as we speak, while our average cost of funds could be somewhere around 8.3. But if we were to borrow anything fresh today, it's coming at 9% plus. So there is already a 50 basis point increase that we are already talking of. But clearly, if there is a demand on the asset side for us to lend, it is not the cost of funds which is going to worry us so much, because it would get passed on or distributed amongst various entities who are supporting this growth. But attention, as I said even earlier, is going to be on the availability, and we will look at every product mix for that matter.
Okay, overall, by how much do you think your cost of funds could rise?
Our expectation is it would go up at least by 50-60 basis point.
Okay, and how much of that would get passed on to the customers?
Consumer may eventually pay only a 15 basis point. My assumption is we will have to absorb at least 15 basis point, and the dealer and OEMs may possibly take 15 each. So the 60 basis point, if it was to happen, would get shared by 4 of us. Consumer takes only a 15 basis point increase.
Could you quantify though, Ramesh, at what rate have you borrowed from the CP market?
I will need to re-verify. I don't have it ready with me. But as I understand, yes, they have also kind of gone up sharply during this period. Maybe in our next call, I can clarify that.
Sure, not an issue.
Okay. Do you see the RBI making lending to NBFCs or capital adequacy norms more stringent, and are you prepared for such a move?
Sorry, I missed you, got cut. The capital adequacy?
Do you believe that the RBI's work towards making the capital adequacy norms more stringent is something that you're prepared for?
I think we already at a higher level as NBFCs. All NBFCs are maintaining that. We, for us in particular, as you know, we just raised capital in November, and our capital adequacy is substantially adequate. We are at about 18-19%. So particularly to us, we don't see that a problem at all. But even otherwise, NBFC as a sector is already at a high capital adequacy level.
Okay, Ramesh, great to have you on the show.